Hello, welcome to another episode of Creative Real Estate. Today, I'm extremely excited to have KPalmer on the call, and he comes from a background in the real estate brokerage. He's worked with a few different groups, which I'll let him elaborate on. He's currently with Walker Dunlop, and I'm extremely grateful to have him on the podcast today so that we can all learn and find out exactly what's going on in his markets. Kyle, welcome to the call.
Thank you for having me, Rikki. It's good to be on. Good to speak with you again.
Absolutely. So I think before we dive into a little bit more on the market, I'd like to hear more about yourself, how you got into the space, and where the passion and love for real estate comes from.
Yeah, so I've been in commercial real estate sales for roughly 14, 15 years now. And so I got into the industry directly out of college. I went to the University of Georgia and came out and got into the business. I figured that sales would be the best industry for me, and I wanted to sell the largest assets that I could, and that's what's bigger than commercial real estate, right?
Amen
and what's more well needed than housing. So multifamily is where I directed myself, and that's where I've been ever since.
That's great. I think that's a good story. So you were attracted to the industry. You felt sales was the right role for you. I couldn't agree more. I think there's no other job that really places the outcome more in your control than a sales role. And I think that's a very wise decision. So how did you get started in the real estate space?
I agree. So I was, I just learned, I understood that was the route for me. So I sought out commercial real estate companies in Atlanta, which is where I'm from, Atlanta, Georgia. And eventually one of the top 10 on my list decided to take me in and let me become a junior agent. And it was just off to the races at that point, which I think anyone in sales would agree. It's you have to have some tenacity about you and some grit, right, to take the lumps for a year or 2 years in the business before really seeing any benefits of your work. And but then it's normally all uphill and blue sky from there, presuming that you stay consistent, you develop the relationships, and you perform along the way.
Absolutely. And tell me, so today you're with Walker and Dunlop. You're based out of the offices in Atlanta, Georgia. What exactly is your role? What are the markets that you focus on?
So my role, I'm with Walker and Dunlop, and we are one of the largest lending platforms in the country for through our agency partnerships as well as our capital market correspondence. And our investment sales team is not that large in numbers. We only have 30 agents across the United States, but we're one of the larger sales volume teams when it comes to multifamily investment property sales. Last year in 2019, I believe we sold a little over $8 billion in multifamily property. And our debt team, our debt platform, I should say, originated somewhere around 30 million in sales volume themselves. So when it comes to agency partnerships, we're the number one Fannie lender and number 2 or 3 Freddie lenders. So we have very close ties with them. So we're uniquely qualified to provide insight into the investment sales and debt marketplace. Absolutely. Now specifically with my role, so I oversee the middle market and private client space within the Southeast region. So within the United States, that's being based here in Atlanta, I cover the Carolinas through Tennessee, Kentucky, Georgia, and then all the way west through Texas.
That's a large base to cover. How do you cover all those areas?
Team members. It's all about teamwork, right? So it's too much for one person, but collaboratively through the team, we're able to touch all the clients that we need to.
That's great. And I think you touched on something important there, is that Walker and Dunlop obviously have this massive lending book. The investment sales team is small, but they seem to have this advantage through that to be able to hit those sales volume numbers that they're doing. And something I've always enjoyed about our relationship also is the ability for you guys to kind of be able to foresee what's coming with clients in future and just know people that might be looking to sell in the near future and those that won't, whereas a regular, just straightforward brokerage maybe doesn't have all of the insight that you guys have with that massive lending division.
Yes, agreed. So specifically, Rikki, how you and I have worked together in the past with your investment groups is we've targeted a lot of the debt maturities that are in our servicing portfolio. So we have Walker Dunlop has 1 million units, roughly 99 billion in maybe 97 billion in our servicing portfolio. I want to be specific.
It's a big number.
It's a big number. It's a big number. So what you and I have done in the past is we've targeted the upcoming loan maturity dates within 18 and 24 months. And we've proactively reached out to those owner operators to gauge their interest in prospectively performing a disposition of that asset, right? And then what their investment strategy moving forward. And then from another side, our debt platform also provides through their long-term client relationships, any of their investors who are in an exchange or maybe an exchange and they've sold a property that now they need to buy another one, or they have one to buy. They have an asset of property that they have identified that they want to acquire, but they need to sell their existing property to relinquish that and then move through the exchange process. So those have also been some cases that we've provided to you and your team in the past.
So just to jump in there for anyone listening that's wondering what exactly he's referring to in terms of an exchange, I think, correct me if I'm wrong, but you're specifically referring to a 1031 exchange, which for anyone that's listening was covered in a prior podcast with Yona Weiss in terms of cost segregation, depreciation, and how to defer capital gains tax. So that's what you're referring to, right?
Correct, exactly. Yeah, so 1031 exchange, it is a capital gains tax deferment process where if you sell here in the United States, if you sell your commercial real estate and if there is a capital gains, then you can, within a certain time frame of 180 days from the date that you sell your property, as long as you acquire another commercial real estate asset that's a cash flow and income producing property, then you do not owe any capital gains tax. So you do not pay taxes on the capital gains. Now, the benefit to the individual in that role of selling and then exchanging reposition their equity and buying another commercial real estate property is, let's say if you have $1 million with gains taxes that you would pay, that $1 million, if you capitalize that $1 million, it gives you a lot more additional purchasing power. So capitalize it by a 6 cap on that $1 million that you would pay in taxes, but now you can go buy a property that's $20 million more expensive, more valuable, because you can exchange that $1 million to help you purchase that next property versus that $1 million going to the IRS.
Absolutely. And it's such a big difference when you work it out, when you actually sit down and do the math. The benefit to you is really substantial. So to be able to identify something like that during that transaction window, even if there's a level of urgency, and without it might seem like you need to do a little bit of an overpayment, for lack of a better description. It's sometimes worth possibly even making a small overpayment on an asset just to be able to achieve that, because otherwise you're effectively giving all of that money away. So,
well, Rikki, so great point. So you and I were discussing this the other day. I have a transaction closing today or tomorrow, and it's in the property's located in Knoxville, Tennessee, and the buyer and the investor. It is. Yeah, it's very active market.
I like that place.
Very good economics. Very good economics. The job growth is holding steady in Knoxville despite the COVID impact. But the buyer in this situation, they were in that exchange situation where they sold a property here in the Southeast, and they would either pay $5 million in capital gains taxes, or they would acquire the property that we've identified for them, and they're purchasing this property at a 4 cap on a year one. That's not in place. I'm not sure if you've covered some of your webinars, but a year one is a 4 cap.
Wow.
So the first 3 years, their return is below 5% through the first 3 years, and that's including a renovation project during those years.
Wow.
So it's very minimal gain in this exact situation, but still the outcome when you weighed option A versus option B, this was much better than paying the $5 million in capital gains tax.
Yeah, I think that is such a great point. So as everyone knows, you generally make money in real estate when you buy, and you also obviously make when you sell. We typically always speak about finding motivated sellers to buy right. And in this situation, I think it's quite unique, and something worth looking at is who are the motivated buyers when you're going for a listing, right? And I suppose that's where you as a broker obviously step in to get the highest value. But just strategically from a sales perspective, if you're someone that owns something, the first point of call that you want to look at as a buyer is, I guess, someone that's going through a 1031 exchange, because they'll have a unique competitive situation over potential other bidders.
Yes, agreed. So how you enter into an investment is just as important as to how you exit out of it. And so understanding why this buyer in this situation would be open to only receiving below a 5% return each year on this investment is because they placed a bridge loan So their debt to fund this acquisition was through a bridge loan, which means it's a 3-year term. It's interest only. The debt is a little bit more costly than a normal, call it agency loan. The
Yes.
debt is around 5% on a rate, but again, it's interest only. And the bridge loan also provides the construction proceeds from the renovation project.
Okay.
And it's also a higher leverage than what most other lenders are providing today. So you put less equity in the deal. It's interest only. It's short-term, 3 years. It provides the cost of capital for the renovation project. So what happens is during the first 3 years, there's almost no return. However, after they've enhanced the interior unit design, they've increased the rents, they've increased the NOI, they've increased the value of the property. So now in 3 years, they either refinance at $10 million of a higher value, so they can pull out their equity, or they can sell again at a $10 million gain. So then they can possibly go through the exchange process again, buying a bigger, better, more quality asset, or they just refinance the debt and then cash flow the investment for years to come.
Nice. Sounds like they've got a healthy appetite there for what they're doing.
Well, that's part of why I love this business is the different options and opportunities that you have. So again, coming back to a platform like ours, they can provide the debt on the front end and the investment sales expertise. I think that's the type of partnership that from your seat that I would be looking for.
Absolutely. Thank you for that. So you touched on COVID, and I think that's obviously the big topic of discussion at the moment. And it feels like every single month we push it out another month. Initially it was, oh my goodness, what's going to happen just after the shutdown? And then no one knew what was going to happen. And then that month came and nothing happened. And I think that was as frightening as something happening because the drop off just really wasn't material in terms of collections. And it seems to be holding up. I haven't checked as of today, but I know that the rent tracker from NMHC seems to be holding up pretty steadily on last year's numbers following month for month. And I suppose the big question is, what are you seeing happening in the market today? I know from our perspective as potential buyers, we want a discount on product post-COVID, but it's a hard argument to make when collections have still been so strong. And then the only other avenue that I think is a real thing on my mind is the fact that rental growth is probably going to be maybe less aggressive as what it would have been in the past, or potentially even just flat or negative over the coming months, or maybe 1 or 2 years ahead if we were to base it off something like the GFC. They're all unique and individually different, but what have you seen taking place in the market at the moment?
So I'm going to back up until through March. So in March, we had 24 deals that we were marketing either marketing or under contract. Half of those ended up closing out at the pre-COVID pricing, and half of them we've halted and paused for a short time, and now we're getting ready to take those back out. So from a buyer pool perspective, we have seen, in March and April, maybe 20% of the activity that we were seeing pre-COVID, and start moving into June, and that number is multiplied by a 4 or 5 factors. So now we're seeing probably 80% of the investor pool is active back in the marketplace. Now within the realistic, I call it more institutional or larger middle market investor, their yield expectations really haven't changed. What we're doing is we're not really discussing cap rates anymore on a year one. We're really trying to back into value based on a discounted cash flow. So as you mentioned, rent rate growth, assumptions over the next 6 to 18 months, how that's going to then flow down into economic loss scenarios and ultimately drill down to the NOI. So we are through the end of this year, we are underwriting with a static rent growth, essentially a zero rent growth on new leases. Now in renewals, we are increasing that to 1 to 3% depending on the property and the submarket. So ultimately, you're going to see some economic loss, right? Some a little higher bad debt, a little higher concession, a little higher vacancy, and a slightly reduced NOI. Maybe zero, might be flat, or maybe 1 to 3%. But this, the impact here really hasn't manifested itself or rippled through the economy that the national media would have you believe when it comes to the impact to investors of multifamily property, because you have to live somewhere, right? And most people are choosing to pay their rent, as you established. NMHC has tracked that very well. So on the deals that we're selling and that we're pitching a broker opinion value on these days, they've demonstrated to be more resilient versus volatile, right? So each, from your perspective, from a buyer or investor's perspective, I'm going to look at each asset and each submarket as whether or not, and the tenant base of that asset, whether it's more volatile or more resilient due to the COVID impact. So
Yeah.
a very easy way to look at that might be the effective rent, right? So we're seeing properties with a $1,500 to $2,500 effective average rent. They're really not being affected, right? So you start dropping below a $1,500 a month effective rent, and those individuals have been hurt some by this. However, the CARES Act with the additional unemployment bonus, that's helped out, and that runs through July. That's most likely going to be extended through December. So almost any economist that you speak to today that shows any optimism at all on what the future holds is going to tell you that in January Q1 of 2021, that the fundamentals are just going to take us back to where we were almost pre-COVID. So if you're looking at deals today, you're 2 or 3 months away from closing. That means you might only have 2 or 3 months of lowered NOI. And then in January, you should be able to start making the same assumptions as you were pre-COVID. So we're not concerned. We're seeing a lot of activity, and each month now, each week, we're seeing more and more activity from both the buyers and sellers who we deal with.
All right. So that's sort of the opinion that you got going forward. What are you seeing play out in the market? You've kind of answered my question already when you said that a deal in Knoxville just traded at a 4 cap. I've seen some similar numbers come through down in the Tampa submarket, still really some really low cap rates going through, some of which I don't even think I saw before COVID, transactions taking place. And I think that's definitely showing a lot of market strength. But what are you seeing from the bulk of the sellers, that activity that you said that dropped to 20% is now back at 80%? But are they giving you any kind of indication as to a discount that they're looking for, or are they just here to do deals and things haven't really changed?
Yeah, so the buyers who are looking for the 10 to 20% discount from pre-COVID pricing, I know we're not transacting with them. I'm sure there may be a few of those deals in the marketplace, but again, the COVID impact really hasn't flooded through the marketplace in a way that puts distress on most owners to say that, okay, yes, I'm willing to accept the 10 to 20% discount on pre-COVID pricing, when if I can hold out for 6 months or longer, then we should be back at a normal in a normal market environment. So if I can hold out for 6 months, why wouldn't I? Versus trying to transact right now. We saw most people who may be in some distressed situation, they just refinance their loan, if at all possible. But we've seen very, very little distress in the marketplace. So from a value or cap rate perspective, look, interest rates are going to remain low for the next several years to come, which means the cost of debt is going to remain low. And we just don't see that really moving cap rates, because again, a normal levered IRR, the internal rate of return over a 5, 7, or 10-year hold period, is still going to maintain it in the mid-teens.
Yes.
And how you approach that's not going to change. That's not really going to lower or dramatically increase. So how you back into that is slightly lower pricing today, but normally 2 to 5%. So most of the transactions we're selling today, this month, that we sold last month and this month, meaning April, May, and June, they've been between that 2 to 6% discount to pre-COVID. Moving forward, for instance, we're negotiating a contract right now on the 400 unit mid-80s built property here in a northern suburb of Atlanta. In February of this year, we're negotiating a contract on the same property at $60 million, roughly $145,000 per door. And COVID came, that negotiations took a pause. We backed off, liquidity dried up, and the investor wasn't interested at that time. So we hit the pause button. We began conversations again a few weeks ago, and we're still back at that same number of $60 million, $145,000 a door. And really, the internal rate of return has not changed.
Yeah, I think it's very interesting. I mean, each property is so unique in its own sense and submarket. It's hard to just give a total blanket approach. We had a deal that we were looking at. So prior to COVID, we didn't get the deal under contract. It was in the middle of everything hitting a mess, and we were still back and forth on the PSA. And, the new group that came over to manage the assets just done such a great job. Collections have increased, utility bills have come down. We're facing the opposite scenario, where they're basically saying, well, we still want to sell, but we believe it's worth more today than it was prior to COVID, And so it's an interesting dynamic. That property was a little unique in the sense that it definitely had some additional meat on the bone from occupancy being below 90% and one or two other clear higher running expenses that could get cut down. But since they appointed a new management group, the property is really performing well and they're actually asking for a higher price. So I think it's one of those industries where you can't throw over a blanket approach and just say, each property is going to be selling at a discount. I think, and to that point, it's probably a good showing that there's good opportunities in any market, whether you're close to the top of a bull or you're moving down towards a bear market. The characteristics of properties at each of them are unique, and I think that's what draws most of us to this space as opposed to the listed space, is that you have that level of insight and control and detail. And I think as an operator, you just got to be specific on what you're looking for and go out and get it.
Agreed. I think that's well said. So tying that back in with the example I just shared, the 400 unit property that we're putting on our contract shortly here in Atlanta, it had some of the same indicators, which was collections have held very tight. Occupancy has only fallen by 1 point. A lot of the major capital expenditures have been spent over the last 5 or 6 years with new roofs, new vinyl siding, repairing to plumbing, repairing to foundations. So a lot of those capital expenditures that you don't want to spend your money on, those projects are done. And 95% of the total units in 400 units are in classic condition where they really have not been upgraded or enhanced over the last 15 years.
Yes.
So to your point, a lot of upside on a post-renovation project and where rents can be. We're just closing on a very similar asset that's a half a mile down the road, and that we sold that at $175,000 a door, and we're wrapping this one up under contract at $145,000 a door. So the forethought is this property that we're tying under contract is going to be the property that we just sold, because they're same unit count, same vintage, identical look and feel. So the property we're putting on a contract will, in 5 to 7 years, most likely sell at $30,000, $30,000 a door more. Exactly.
No, that makes a lot of sense. I mean, it wouldn't surprise me if they end up getting a higher price than that. So I'm curious, in their business plan, do they plan on running a value add today, or is that something that they prefer to put on hold for the year and then run a value add in a year's time?
Good question. They're going to let this year play out.
Yeah.
So we'll close on this in 3 months. And that only leaves 3 more months in the year. So they'll let the fourth quarter kind of just float by, and then they'll reassess in January, which most likely they'll kick that renovation project off in the second quarter of next year.
Got it. I think that makes sense. I've heard a lot of different operators taking that approach at the moment. So I'm always curious to hear what others are up to. In terms of the current market, Class B and Class C, across Georgia, Tennessee, what are you sort of seeing? I think you mentioned Alabama as a market too, right? And Texas.
Yes.
So what are you seeing over there in terms of cap rates on, call it 80s, or actually let's start one back, call it 70s product, 80s product, and I'll put 80s and 90s together, and then 2000 plus. What kind of cap rates are you seeing in those two markets?
So in the larger MSAs, the larger MSAs, primary markets, we're seeing those 70s and 80s vintage deals. They're going to trade at a 4.5 to 4.75 in place cap, meaning that year one pro forma is most likely around a 5. And that's with the presumption that a large percentage of the units are unrenovated.
Okay.
Now on the properties, the 70s or 80s or 90s deal that has already been 60% or more of the units have been renovated, it's going to be probably 25 basis points higher than that.
Okay. That's a good distinction. Thanks for putting that out there, because I've, a few of the different groups that I work with are obviously looking for different product, and it definitely plays to the point and to the strategy as to what's possible. So these guys that are paying, and it's counterintuitive really, if you think about it, in the sense that you're paying more for something that hasn't been renovated. But the reality is when you can increase that rental and increase your NOI, the value is obviously going to go up substantially higher. And it's maybe just a case of accounting for that slight reduction or increase in basis points rather on the exit. So that's interesting. Sorry, you can continue.
So then once you start moving into more secondary markets, you're going to see that cap rate rise again, generally 20 to maybe 30 basis points. And that's within conventional market rate deals. I'm not sure if your question was maybe tied also to student housing or affordable housing. Those are entirely different animals.
Yeah. I think let's just stick to market rates, multifamily.
Yeah. But again, so the Knoxville deal, that was a 4 cap on an in place. It's going to be very much specific to the asset, to the buyer.
And the vintage, like the year of that asset?
1983.
Oh, wow. So 80s product at 4 cap. That's incredible.
Yes.
We got a while. I think I got a while before I'm going to become competitive at the betting table again.
And that's not normal, right? So
Yeah.
we rarely see that. That's the black swan event, but for a seller anyway. But it's still a good deal for the buyer. They're going to be in a very good position 3 years from now. They'll be very happy. In the meantime, they're going to have to grit their teeth a little bit and just stomach a lower return. But it's going to be a very good deal for them on the exit.
Okay, so we've got 70s and 80s product in primary markets between all around a 4.7 sub 5 cap, so to speak. And then you had that distinction between the value add versus non. What are we looking at kind of 2000 vintage, maybe not new construction, but 2000 to 2010, that kind of a property? What are you guys seeing over there?
So I'm going to put that more into the core plus core category on quality of the asset and location. Your 90s, probably more 2000 built and newer. That's, obviously the cap rate, the yields there are going to be reduced because the likely buyer pool, the investor who's attracted to those deals, they're more institutional in nature. And most of their equity partners, they're agreeable to a much lower rate of return on a much longer hold period. So most of our team in Walker Dunlop on the investment sales team, that's what my colleagues' focus is more in the core plus core space, where mine is the older vintage value add deals in the B&C property. So we see a lot of the core plus and core product that we sell. You're dipping down into the low and mid 4 caps when it comes to those properties. And again, it's because the equity partners have a much lower yield threshold.
And then the same question for secondary and tertiary markets. What do you see over there?
So we're not even seeing a lot of those deals being very active right now because most of those investors are expecting a deep discount to pre-COVID. Again, those sellers are still in the same bucket where if there's no distress, there's no reason to dispose of the asset at this time. So they're just holding tight. So we're not seeing very many transactions in the tertiary markets at this time. I anticipate probably later this year that'll change. It'll increase once the buyer expectations relax a little bit on what the pricing should be. I think that'll probably in the September-October timeframe, we'll start to see the tertiary markets get back to the same cap rate environment that we were at pre-COVID.
Okay, moving on from there, where do you see the most value in the market right now? If I gave you $1 million, maybe that's not enough, but if money grew on trees and I could give you whatever you needed, what would you be buying in terms of size, class, and strategy?
Oh, good question. I'm going to look at every deal. So kind of going back to what sales is, right? So sales is normally a numbers game. Even from an investor's perspective, it's still a numbers game. So whereas I'd like to hear your thoughts on this. I think pre-COVID, you were Rikki, you were probably seeing 100 deals, and you would really deep dive into maybe half of them. You would of those 50, you would probably actually offer on 20 or 30. And then you'd probably end up investing final on a few, and you would win 1 or 2 of those, right? So now post-COVID, I would anticipate you have to look at more deals to win those 1 or 2. Now, what that number is, I'm not sure, but you need to deep dive into every because this does come back to the resiliency of that tenant base of the property and the submarket that it's in, right? So even in an MSA like Atlanta, Georgia, comparing a property on the north side versus the south side being a little more economically challenged versus the north side, it's going to be a big indicator on what your growth assumptions and future yield projections may look like. So I'm going to look at larger MSAs to answer your question. Our team is tailoring a chart right now, a deliverable that we can pass out to clients at Boston. So our team is actually, we have our analysts structuring a deliverable that we can deliver to clients that speaks just to this, which cities, which MSAs, based on prospective job growth, on just resiliency across the board to COVID, would we recommend looking at over the next 6 to 12 months from a buyer's perspective. And obviously we're sticking mostly to the Southeast. And to give you the answer, it's Atlanta, it's markets in Tennessee, it's definitely the larger markets in the Carolinas, Raleigh, Charlotte, the Triangle. Florida is a very strong marketplace. We're expecting Texas will probably pick up early next year, but right now through the end of this year, we're not seeing Texas as being the highest MSAs in our list that we would recommend. But it will be again. It was before, and it will be again.
Yeah, that's very interesting. Is there a specific reason around that? Are you just seeing a lot of the employment sort of susceptible to COVID kind of drivers, or what is the main reasoning for that?
So I think it probably boils down to three things. So one, MSAs like Houston or San Antonio, especially Houston, which has a very large exposure to the oil and natural gas sectors, which have been devastated here recently.
Yeah.
Probably not good markets to buy into unless you're getting a deep discount, because
Yep.
again, Houston will come back out very resilient on the back end of this.
Yep.
MSAs like DFW it's almost oversupplied right now. There was a very large deliverable of new construction units
Yep.
being delivered over the next 2 years through 2022. So that's going to affect the supply demand factor there, along with having some job growth declines as well. And then Austin we're still seeing very, very high cost basis. So in other words, the price per unit, price per door that you're having to buy into a deal there, we're not seeing any immediate near-term value gains.
Okay.
So if you had very long expectations on your hold strategy, then Austin may be a market today to look at. So in other words, Texas, I'd probably give Texas 4 to 6 months before venturing over there.
That's interesting. Yeah, I appreciate that feedback. You mentioned the areas that you buy in or look at. Okay, so actually there's a few things I want to cover. So first of all, where do we gain access to this magic Walker and Dunlop report that's come out? Point number one. And then point number two is really, is there a specific strategy you would personally look at doing right now when it comes to value add versus rather buying 2,000 product and just riding it out over the next few years and passing the value add onto someone else as an exit strategy? And then also just speaking to the size of properties, are you seeing a bit of a discount with smaller apartments as opposed, or call it 50 to 100 units as opposed to 150 plus? Do you see a bit of a pricing differential there?
So we're absolutely seeing more competition, more interest in properties over 150 units. Really 200 is where we see the most interest, because just the economy of scale starts to get to a place where moving rents and moving some of the economics can make a bigger difference when you drill down to the NOI. Let's see. So some of your other questions. The MSA report, we'll be able to put that out July 1st. So we'll certainly send that to you at that time, so you get your hands on it.
Great. I'm going to hold you to it. So if anyone listening wants to get access to this report, will it be on the Walker and Dunlop site, or do they need to?
Oh no, it's something that we'll need to send to you directly. Yeah, we're not going to probably distribute this, but to the trusted clients such as yourself and many of your listeners, yes, we can provide that to them.
Perfect. And we'll just add how to get in contact with you at the end. But for now, you can get on to the next question.
So, and then on the renovation project. So if you're looking at an asset that has a significant number of its units are unrenovated, our recommendation would be to maybe take that to a 60 or 70% renovated total of the total property. And in some cases, it may be a good investment strategy to actually renovate the vast majority of them. So if you're familiar with a DST, Delaware Statutory Trust,
yes.
So those funds were extremely active pre-COVID, and their target property was one that has already had the value add program ran through it. So in other words, there's really no capital expenditures, large capital expenditures to spend. The value add program has been run through, so they can benefit from the rent growth over the next 10 years without having to go through a lot of the pain and brain damage of those projects. So those DSTs were very active pre-COVID. They've taken a back seat during the tumultuous times that we've had over the last few months. I anticipate early next year they'll come back out. So there is a buyer pool for properties that have been 90+% renovated. It's not that you're not leaving enough upside for the next guy. It's just a different buyer who you're marketing the deal to. But in a general sense, I would probably look at renovating 70% of the total unit size. And within that, you have to look for the other local competitive properties who have demonstrated what the right unit enhancements and upgrades are, versus trying to go way above and beyond what everybody else has done in the submarket. Look at what else has been proven, and essentially try to replicate that.
Yeah, I guess you don't want to overcapitalize on something when the market just isn't there to support the rents you're trying to hit through.
Yes, if there's not going to be a sufficient return on cost, then there's no reason to spend $15,000 a door in renovating when 10 will get you where you need.
So moving on to the next question, what are your top 3 to 4 pieces of information that you look for, or that you would recommend a buyer looks for when going into a submarket?
So 4 things that an investor would look at. when they enter a new market.
Yeah. So let's call it the three main pieces of information you would recommend an investor looks at before entering a submarket, and why?
So historical rent growth would be a big indicator, but where was that rent growth? Was it specific? Let's say it's a larger submarket. Hopefully it's not a small data pool that you're pulling from, but there's a substantial number of properties in that data. What was the rent growth contributed to? Was it one large employer coming in, or was it many different businesses coming in and growing new jobs? The average household income is a big indicator. I would recommend staying above 50,000. Obviously, the higher the better. 75,000 within a 3-mile radius is very strong. And then the supply and demand factor. So how many other new projects, new units will be delivered within the next few years? What's projected? What's historical? Again, is it normally 2 or 3%? Is it less? Obviously, less is better.
Got it. Yeah, I think those are spot on. Thanks for that. And then the final question that I got for you today to end off is, what's the 2 most important things that you've learned in the industry as a broker?
Good question. Oh, things I've learned. Get used to taking lumps quite often, right? Hearing no a lot. I mean, Rikki, you've told me, I don't know how many times you told me no, right? On some of the deals I've sent to you, right? For whatever reason, it didn't work. But it's sticking with it. So I know that's one thing you've done very well, is you've determined what your goals are, and you've stuck with it, and you'll come out better on the back end because of that. But I would say determine what your long-term goals are, and then determine the right way to get there. So if it's owning 20 multifamily properties within the next 10 years, well, then back into what you need to do each step of the way, each and every year, in order to obtain that to the 10 year.
Great. Thank you so much. Well, I think that's pretty much how we're going to conclude the podcast today. I really appreciated you being on the call and setting the time aside. How do people get hold of you if they want to look at doing some deals in the near future?
Yes, no, thank you for having me, Rikki. So anyone can go to the Walker Dunlop our Walker Dunlop website, and all of our WD investment sales team, but we're all on there and easy to find. But my direct email address is KPalmer, PALMER, @walkerdunlop.com.
Great. Thank you so much, Carl. Once again, I appreciate having you and look forward to having you on future podcasts.
Thanks for having me, Rikki. Take care.
Cheers.